Today we're going to cover 5 beaten down growth stocks. On these stocks, 4 of the 5 are down over 75% from the highs. One of the stocks is down 55%. Now, just because a stock is down 70, 80, 90% from the highs, it does not mean it's a buy. I use a total of 12 different criteria in a screener to find these 5 stocks. In fact, I own 4 of the 5 stocks, and the 5th one I used to own, and I'm thinking about buying it back. So in this video, we're gonna cover those 5 stocks. I'm gonna give you a high-level overview. This is gonna be rapid fire. I'm gonna discuss each stock really briefly, and I'm gonna give you some valuation metrics and some commentary. So let's just get right into it, guys. The first stock is gonna be MercadoLibre. Now, of course, I'm not saying that you should just run out and buy all these stocks right here. Typically use dollar cost averaging, and we're thinking long term. So we're trying to back our way into stocks and hold them for 5 or more years unless the story changes, and we're using dollar cost averaging. We're not buying everything all at once. Now, this one right now is $881. If you look at it, the 52-week range, it was $600. This got on June 14th. So the low, June 14th, $600. The high, September 2nd, 2021, it was almost $2,000 a share. So for all 5 of these stocks, guys, I'm gonna use price to sales so we can compare them apples to apples, but I'm also gonna use things like price to earnings, PE ratio, if the stock has one. And for the cloud-related stocks, we're gonna use EV NTM revenue. You can see MercadoLibre, guys, 194 on the PE ratio. So that's pretty expensive, 195. Look at price to sales, it's a 5.03 price to sales. Now looking at a chart, this certainly could go lower. I think this could get down to even like $700 a share. So you have to just keep this on your watch list and keep an eye on it. I think it's attractive at $881 a share, but it could go as low as $650 depending on what happens to the overall market. Now these are not in any particular order, but the second one on the list is gonna be apps, Digital Turbine. Now the low on this was June 16th, it was $14.43. It topped out November 1st, 2021, like a lot of growth stocks at $93.98. This is trading under $20. I think it's attractive under $20. It certainly could come back to that $15 range. I think it's an easy one to dollar cost average under $20, thinking long term. The last earnings report I thought was pretty solid. We look at the PE ratio, it actually has a 62 PE ratio, so not cheap by any means, but impressive growth for that metric. On the price to sales ratio for apps, Digital Turbine, 2.78. That's pretty attractive. Now this next one is Toast. Now this was a new IPO in 2021. It ran all the way to $70. The low on it was under 12 bucks. And we started buying this in the Fired Up Wealth Investing Club, the community portfolio, when it got, I think under $13 is where we started buying it. So it is quite a bit off of that low. Now they just reported earnings not too long ago, pretty solid earnings. If you look at the valuation metrics on Toast, of course it doesn't have a PE ratio. So we're gonna look at price to sales. It's 3.96 on this one. EV NTM revenue, it does have a SaaS component. It's not all SaaS, so keep that in mind. So Toast is gonna be point of sale, and it's gonna have a combination of hardware as well as software. So it's not true apples to apples comparison on SaaS, like comparing it to CrowdStrike or something like that. But with this one, the EV NTM revenue is 3.1x, so that's getting pretty attractive. This 4th one, everybody seems to hate. The market hates this, it's Twilio. Now this thing, it's basically at the lows. It was $72.10 on August 26th. It's trading at $72.62. The high on this was $373. Of course, it doesn't have a PE ratio. This is gonna be more in that recurring revenue cloud SaaS model, but this is also consumption-based, so it's a little bit of a unique one. But if you look at the price to sale, it's under a 4, so it's getting pretty attractive. The EV NTM revenue on this one is 2.8x. Just to give perspective, I'm not comparing the 2 companies by any means, they're very different, but Snowflake is a 25x on the EV NTM revenue. This one here, Twilio, is 2.8x. Just for some perspective, it's 10 times cheaper than something like Snowflake. Of course, it doesn't have the growth. Now, the last earnings call, I listened to it. I am a shareholder of Twilio. In fact, all the stocks we've talked about so far, I do own, and I've been buying these levels and lower. Now, with Twilio, there are some concerns about profitability, of course. They say they're going to be profitable at the end of 2023. There's also concerns about compression in the margins and also slowing growth. The growth for the valuation, I think, is still attractive. It's not hyper growth anymore, but it's still attractive at these prices. And when you look at the margin compression, part of the reason for that is because of the international. The more international customers use it, it's a little bit less expensive for international messaging. So that volume has actually decreased their overall margins. So, can this go lower? Yeah, I think it could go, 55 even. But if you don't own this stock and you're starting a position and your first entry point is a $72 entry point, I've had this stock for, I don't know, 3 years, and I'm down on it. I think my cost basis is closer to like $140. This thing was $373. I'm not saying it's going to go back to that anytime soon, but it's a quality company. I think the company is going to be around for a long time. It wouldn't be a terrible spot, in my opinion, to start a position. Now, this last one's a head scratcher. I used to own it. I sold it. It was around $20 when Zillow Group reported, and they had a dumpster fire of earnings last year. And I got out of it, took profits actually around 20. And I just said, I don't like this at all. I'm getting out. Now this thing's down under $5. This thing was $25 in November of 2021. And it got down as low as $4.30. So this is as close as the lowest you could ever got it. This is one that went public, last year, 2021. Of course, it doesn't have a P ratio, but listen to this. Price to sales ratio, 0.2. 0.2. So the market basically thinks this thing's going to go out of business. And if it doesn't, this could be one of those that gives you a 10X or zero. It's a great spec play. Of course, housing is very bearish right now. There's a lot of people that think it's going to get worse and worse. So the numbers might slow down. But if you look at the growth metrics that I use when I did the screener, these guys are pretty solid. What I'm going to do next, guys, I'm going to show you all 5 stocks and show you some of those screeners. Okay, so here's the 5 stocks I just covered. You've got Opendoor, Toast, MercadoLibre, Twilio, and Digital Turbine. Now again, dollar cost average, this is long-term investing, not trading. So revenue growth, when you look at last quarter versus quarter prior year, so that's comparison. Opendoor, 254% growth. You got Toast at 58, 52. These are all solid numbers. The lowest is Digital Turbine at 19.3. Book value growth. Now you can see a couple of these are pretty new. So Opendoor and Toast haven't been around very long. So that's going to be blank on some of these metrics. But when you look at the book value growth, 101% on Twilio, cash flow growth, 191% on MercadoLibre, 93% on Twilio, and 292% on Digital Turbine. These companies are performing really well. They're doing really well. It's just the market hates any kind of growth. If there's any speculation at all, the market just does not want to touch it. These are the kind of stocks that you buy when everybody's afraid, and when the market turns around, in theory, you're going to make a lot of money, and you're not going to be right every time. But I look at all 5 of these stocks. I think all 5 of these have tremendous long-term opportunity and potential in front of them. Revenue growth, the TTM versus prior year TTM. 512% revenue growth on Opendoor. Market cap. So Opendoor is a $3 billion market cap. Toast, $10 billion. You can kind of see here MercadoLibre is a $46 billion large cap. Twilio is about a $14 billion mid cap. Digital Turbine, another small cap. That's the smallest one on the list, actually at $2.13 billion. A lot of people might be surprised the market cap's actually smaller on Digital Turbine than it is on Opendoor. So right here is where you can see how much they're down. So Opendoor is down 81.82% from the 52-week high. Toast is down 73%. MELI is down 55%. Twilio is down 80%. And apps is down 78%. These numbers fluctuate a little bit because the market's open when I'm talking, but they're all down over 50%. 4 out of the 5 are down 75, 80%. So again, it doesn't mean it's a buy necessarily. And even looking like the analyst opinions, again, I wouldn't go buy a stock just because of that, but all 5 of these have buy ratings. All 5 of them have buy ratings. You look at the valuation and growth, these are solid numbers for the most part, especially for the valuation. There's some volatility with all 5 of these stocks. Guys, if you have not subscribed to the channel, please subscribe, click that bell to get notifications, drop a like and a comment. Also, this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/fired up wealth. And I appreciate your time and attention, guys. Have a great rest of your weekend. Take care.